especially as growth prospects start to flag. Dominic, thank you very much for that. Let's expand the conversation. Joining us now, Sean Darby from Jefferies, Drew Nordlicht from HighTower, Tim Leach from U.S. Bank Wealth Management, and Doug Cody from ING Investment Management. Guys, good afternoon.
Well, thanks for having us.
Hey, look, it's been a tough afternoon as well. Doug Cody, first to you, just a question here as we see the Dow down about 130 points at the close. Is there more to go?
I would say maybe a little bit, but investors don't want to make a mistake of trying to watch it to improve their portfolio. This is an opportunity for defensive investors to get fully allocated and look at global. Global has been a big performer this quarter, vastly outperforming large cap and U.S. equity. So broad global diversification is really the answer to these type of uncertainties.
Sean, you think this is the time to play offense?
Yes, I do, actually. Global growth has actually been picking up over the last quarter. Got a resynchronization from China, Japan, through to Europe, to the US. This is a little bit of a hiccup. I think it's time to actually be buying some cyclicals in the US, some transportation stocks, and some sort of, paper plays as well. So I don't think it's time to start going into the sort of pharma, telecom, or utilities.
At the same time, Drew, I mean, we are talking about something that's going to have a real impact on GDP growth. We're not talking about an economy that's growing much above 2%.
That's right, Kelly. Well, we think if the shutdown lasts for a week, it will shave about 0.3% off GDP, which is about 10% of the expected growth in Q4. That being said, we think the bigger market event is the Fed non-taper from earlier last week. While that's going to be supportive of asset prices, we do expect volatility to be continued. And later this week, we get the manufacturing data on Tuesday and the employment report on Friday. So there are some significant economic events due out later this week. We'd use the market dislocation that we're seeing induced by political elite jockeying for higher ground as an opportunity to continue to add to high-quality equity positions because we do expect the monetary printing press to continue even with a government shutdown.
Hey, Tim, why is now not the time to just sell or stay out of the market? We've had some great runs for stocks this year. This quarter, we just are putting a button on here, 11% for the NASDAQ, 5% of the S&P. Why not just take your money and run at this point and not leave it in the hands of the folks down in D.C.?
So I guess the answer to that, Scott, is that it's one answer to that is where to run to. The other answer is that equities are actually in pretty good shape to continue from here. We see corporate balance sheets being fairly clean. We think that valuations are still very reasonable. And so we're optimistic about the road ahead for equities. This high theater does give us a chance to buy in at somewhat cheaper prices.
Sean, it's interesting because we do have some positive trends out there as well. I mean, if you look at what's happening in crude oil today, it comes on top of a big leg lower, and in fact, a leg lower in gas prices. Going into the holiday season, do you think that's going to wind up being a trump card?
I think it is, and inadvertently, we've got an unwind of the whole Middle East crisis going on at just at the same time the Washington, D.C. crisis evolved. But I think the one thing that has to be remembered is you've got a steep yield curve in the U.S. that's pro-growth and tends to be pro-equity as well, and that's really what's occurred since May of this year. The yield curve has steepened, and equities have done very well, and I think that's still the case today.
Drew, we're going to have earnings in a week. What's the story going to be?
We think you're going to see a continuation of the trend where earnings beat expectations, but revenue is still challenged as there's not as much global growth as what most market participants would forecast. While that having been said, for the last 4 quarters, that's been a good enough story to continue to allow the market to reach new highs. And again, the most important factor sitting underneath our asset prices is the fact that the Fed is on full throttle and will continue to be so through the end of the year.
Doug, there are a lot of people watching who have been out of this market perhaps for years and starting to think about getting back in. They're worried about getting in at or near all-time highs with all of the event risk out of D.C. we've been discussing. What's the case for getting in now as opposed to waiting until, say, January for a clean slate?
Well, do it in a way that doesn't game diversification. If you're a 60-40 investor, get fully invested not just in U.S. domestic equity, but also emerging markets, international markets. On the bond side, some floating rates to hedge some of the rising interest rates. And what investors need to keep in mind is the fundamentals are still strong. In addition to corporate profits, broadening manufacturing, consumer bolstered by housing, and developing emerging markets are a source of growth for U.S. corporations.
All right, Drew, Tim, Sean, Doug, we will leave it there, gentlemen. Have a good rest of the evening. We now have less than 8 hours to go before a government shutdown. What companies in your portfolio stand to take the biggest hit? We'll look into that coming up.
Then Apple CEO Tim Cook finally meeting with activist investor Carl Icahn today. Does this spell trouble for the company, or should shareholders be excited? We're going to dig into that and much more on the closing bell. We'll be right back.